Welcome to part two of Wall Street Wednesday with Professor Milligan. This is part two from July 1st, 2020. What you're looking at now is a shelf offering that was brought to market, secondary public offering. It was a shelf offering, and a shelf offering means that the paperwork was done, sitting on the shelf, and the secondary was brought to market after the market closed on the July 15th, market closed, and they set the price that night. All right. So what you're looking at here is a shelf, and like I said, like that. You're looking at a shelf offering. All right. What you're looking at here is Black Knight Industries and the secondary offering that they did. This secondary offering was a shelf offering. What that means is after the market closed, they priced the deal at $70.25 off of basically a $74 close, $73, $74. And as you can see, the next day, the stock traded as high as 75 and change, and then it pulled back and it's traded sideways. One of the things I tell you guys is if the stock has never broken its resistance level, its initial public offer, if the stock has never broken below the pricing on the secondary, in this case, $7.25, I would stay long and look for this thing to attack the old high and go higher. Now, this is not a stock I would buy, only because this is not a company I would buy. But I have traded the secondary, and I would trade this secondary based on this movement. The next stock you're looking at, FOXF, Fox. Again, it was a shelf offering. They brought it to the market on July 17th. On July 16th, the stock closed a hair above basically $81 and change. They priced the deal in the hole at 76. As you can see, the stock opened up at 76 and went higher. It has traded higher since then. This is what I'm talking about. So if you own the stock at 76, you held it for a day or a couple of days, and you got $81 out of it. And actually got a little higher. But this is what happens with shelf offerings. They literally just drop the stock on the market. Now you're looking at another one, PLMR. Again, a shelf registration. And all shelf registrations are S3s. So if you're not sure, you can go find the registration. I showed you how to get the actual registration by either going to Free Edgar online or going to NASDAQ.com and then going to the SPO, secondary public offerings. So again, this was just dropped on the market. The stock on the previous day closed around 85 and change. They priced it in the hole the next day at $82 a share. The stock, as you saw, broke 82. And based on our strategy, if you own the stock and it broke 82, you would short it. And once the stock went back up through that pricing, that offering price in the secondary of 82, that's when you would get long. Once the deal was priced, you saw that it was priced at 103, opened up at that 103 level, went higher, went through 103. You saw it went through 103 to 110. You can see the volume behind it. So it was a nice little trade again. If you got 103, 106, you picked up 3, 4, 5 points in 1 or 2 days. That's a nice little trade. Build.com. This was a secondary. This was not a shelf offering. So Build.com is an IPO that came public several months ago. It's done extremely well. Watched it, traded. So they announced the secondary, and as you can see when they announced it somewhere back in here. This was not a shelf registration. They announced it. Stock came in a little bit. Then they priced the stock that day at 74 and 25 cents, which is basically slightly in the hole from where it closed. And then the stock ran from there. This is what they do. I'm telling you what they do. And in this case, you can see the volume down there. You can see that when this secondary was announced, that they brought that stock in. They were getting short. That's what the investment bankers are doing. We follow their lead. If they're getting short, we're getting short. All right? That's what we do. DraftKings, another interesting story. DraftKings went public not too long ago. It weathered the storm of the coronavirus, and the market sold off back in March. It weathered that storm, went to a high, They announced the secondary, and look what happened. Stock started drifting down, no volume. Why? All the buyers stopped buying because they knew that DraftKings was coming to the market with 40 million shares. So buying stopped. Investors felt like, why buy it? When they dropped the secondary on the blocks, I can buy some stock then. You can see the deal was priced at $40 a share right here. So again, came here, they ran the price above 40, they priced it slightly whole at 40, and the stock broke 40, and it's been trading around this, trading here for a couple of days on the 22nd, and then it's broke down. And right now the stock is trading somewhere around $30 a share. So here's my point on this. If I were you, and I'm looking, if this stock, when it does work its way back through that $40 number, I would look to get long through the $40 number, expected to challenge that $44, $45 all-time high. Now, since I put this chart up, stock has drifted further down, and that's a function of the market. So again, as I always tell you guys, when you're trading these secondaries, the one thing that you need to your advantage is you need the market to hold up. Now, if the market breaks down and it's a company that was having problems before they did the secondary, or had an ugly chart, you can expect this thing to break down further. All right, here's another secondary was announced. This was announced. As you can see, the stock was trading here around 50. Stock was trading at over $100 a share. It just recently had a 2-for-1 split. They announced that they were going to do a secondary when they announced the split, and you can see that the stock has started to drift down. And as the stock drifted down, they priced the secondary. They priced it at $43 on this day on the close. That was the closing price. Since then, I pulled this chart up, and that recently the stock has not broken through the 43 and has actually drifted lower. Again, on this, I would watch this. If it does attack and break through that 43, I would expect for it to attack and go through and try and attack that $50 number. Again, you need this to be a flat to up market, but that's what's going on. And by the way, whether you know it or not, all these stocks, when they announced their secondary offering that I'm showing you, were trading at or just below their all-time high. SITM traded this one too. Another new issue, been around for, this one's been around, I guess now for about 9 months. I don't think it's been a year yet. They announced the secondary, stock traded higher. Just before the secondary, the stock came in a little bit. They priced it at $32 a share, which means they priced it in the hole. And you can see right here where the pricing is. They priced it this day off of this close. Stock closed around 30. You can see closed at 36, 37. That's the close right there. You can see they priced it in the hole at 32. It opened up there and proceeded to go higher that day. And it has not been back to 32 cents. So again, if you brought this stock when it was down here at 32 and you brought the stock because you liked the way it was trading, which is what I would recommend. Now, I didn't do this one. I missed it. I didn't see it. My fault. But again, a buy here and a stop just below the pricing, somewhere around 31, I'd have put a stop. And you can see that this stock digested that secondary and moved on. So again, you can see if you got anything around the $35 range, you saw 15 points. You know, you saw this thing trade up to $50 in basically what, less than 2 weeks. Actually, less than a week probably, up here to 50. And it came up here a couple of times. I'm not sure what it's trading at now, but you can see that. And I'll draw a little bit on this just so you guys can definitely see what I'm talking about. And what you'll see is that right here is probably near-term resistance, give or take a couple of bucks. And you're probably looking at support somewhere right around in here. So yeah, it's in the trading range. I'm not sure if it broke through either way, but based on the way the stock's been trading, if the market holds up, I would assume it trades through. You're looking at NASDAQ.com website, and this is their secondary public offerings. Let me work my way from the top down. What you're looking at now, this is what's on the table for July. You can go back to June, May. I've gone back dozens of years. I don't know how far back this goes, but I've never had a problem when I went back looking for stuff. The way this is laid out, up top you have, at the top of the page, you have the secondary public offerings that have gone public. There's the call symbol. There's the actual name of the company. There's the price. There's the number of shares. And there's the actual data when the offering. And you can see how much money they raised. So it was a small offering, $13 million. Now, what's key on this also, this is a picture, so you can't see it, but you can click on this, and it actually will take you to the filings and other information that you can find out on the company. So you can actually see the SEC filings, and you can see if it's a S1 or S3. Underneath the list of deals that were priced are deals that are expected to come this month but haven't been priced yet. So those are underneath that. And then underneath those is a list of stock or deals that were either canceled or postponed. So this is the NASDAQ site. This is all free. You can click on here. As I mentioned to you, I do pay for a service that I get that gives me all this, but this is free and it's just as good. So a lot of times I'll use this. What you're looking at here are the secondaries that have been filed. These are filed. Now, the one thing that we don't know in this, and this is why I don't use this site, I'm just showing you there's other places you can get information from. I'm not sure which one of these are S1s or S3s. So I'm not sure if they're shelves or coming tonight, or they're more traditional secondary offerings. I can't tell what it is. So I'd have to do a little more digging. Again, here's another site that you can go to get information. And then here's another site. Now, this one is the Pro Edgar, which I was talking about. And as you can see, this is the Pro Edgar again. And without going into too much detail, you can see secondary public offerings. This is the offering. This is the filing. Secondaries priced. This is the IPO search and the secondary public offering search. Edgar is a free site, but Pro Edgar charges. So you can also get the same information from Edgar Online. They just won't have it compiled as nicely. And what that means is Edgar Online will give it to you for free. Edgar Pro, or Pro Edgar as it's called, this one's charging you because they're putting information together for you. And as you look, you can see SPOs that were recently priced. And looking at these, and then you have down here, these are SPOs that with file dates. And you can see there's the the 2-4 Inc., which is IIVI, which we already looked at, that secondary, so it came. What else did we look at? We didn't look at any of the other ones, but you can see it, and here's a list of more. These were filed, these were priced, and then they have here a list of the best performing secondary offerings and the worst performing secondary offerings. These were offerings that were withdrawn. As I mentioned to you, you'll have secondary offerings that are withdrawn for whatever reason. The price of the stock fell, the market has no interest, you name it, there's a number of reasons, but this is what you're looking at. And you can see in June, there was only 3 stocks, 1 in May, 1 in April. So this is not what you would call a popular list, but it does happen.